Hey there, everyone. Welcome to our latest episode of the Market Misbehavior podcast. I'm your host, Dave Keller. I'm the founder of Market Misbehavior and the president and chief strategist of Sierra Alpha Research. Our goal here with the Market Misbehavior podcast is to sit down with top market practitioners, investors, money managers, traders, authors, educators, visualization designers, as we have on with today's guest. Anyone who follows the markets closely and has something important to share. We love sitting down with them, picking their brains a little bit, learning some of their lessons learned along the way, and trying to get a sense of how they're navigating the markets in uncertain times. Today, we have one of my good friends, Julius de Kempenaer. Julius is the creator of the relative rotation graphs. I actually met Julius a number of years ago, probably 20 odd years ago, in New York at an MTA conference, now the CMT Association. And I remember meeting Julius. We were introduced by a mutual friend at a cocktail hour that one evening, and just immediately hit it off. Had great conversations about data visualization. I was at Bloomberg at the time, and he was working for a broker. I want to say based in Gibraltar. It's been a while, I'm pretty sure. But Julius said, his career had been on the sell side, based in the Netherlands. And we had a really good discussion about data visualization, and very quickly turned to this visualization he was working on that he was including in the final page of his research reports every week, which was eventually called the relative rotation graph. And the moment I saw that, the moment I started talking with Julius and asking him questions about how he created it, what sort of insights he would draw from them, I was completely hooked. And to this day, it's something that I look at pretty much every single trading day, because what it does is he has found a way to take technical indicators that we use and use combinations of those to, create a visualization that really shows how the 11 S&P sectors rotate around the benchmark. We talk about sector rotation, but so often we do it in tabular format, looking at a performance table, or we do it looking at individual charts, sort of looking at their performance over time. Julius created basically a scatter plot version of that really shows the interplay between relative performance and the momentum behind that relative performance. And nowadays you can put that RRG graph in motion. You can use it on stock charts among many other platforms, Bloomberg and Optima, and many others that I've been able to use. And it's become a key part of my own way of understanding sector rotation. I know for many in the institutional investor community would say the same. In this conversation with Julius, I did ask him a bit of an origin story, so you can learn how he developed this visualization, and particularly putting it into motion, and the value of looking at how sectors are rotating over time. And to be clear, it's not just on sector rotation. You can do it for asset allocation. You can do it for, styles and cap tiers. So look at large cap growth versus small cap value, looking at different asset classes like commodities, currencies, and stocks. So after we sort of went through the origin story, we talked about growth versus value. We talked about different areas of the market that have been strong in 2024, and how that picture may be changing here in the early days of 2025. I found Julius to be a little more optimistic than some of my recent guests in terms of thinking of the instability, or I guess the choppiness here in early 2025. He saw that more temporary, and really spoke to this continued strength in growth areas of the market, like consumer discretionary, like technology, like communication services. We talked about some of the subtle ways that he uses that RRG. It's not just a simple, let's look at how these things rotate. We talked about cyclical rotations to the right of the y-axis, and I showed you an example with the XLY that Julius talked through that I think was really interesting, because I've personally found that to be one of the most effective opportunities using the RSI and finding investable ideas. We talked about a new effort he's gone through called the Best 5 Sectors. He's written an article now every week for stock charts where he talks about the best 5 sectors using a multiple time frame analysis using the RRG. And I love how he's continuing to innovate here in 2025, years after he initially designed the visualization. So I hope you'll enjoy that particular part. It's sort of what's next, maybe an RRG ETF in the works for investors. Hopefully very, very soon. A really enjoyable conversation with someone who's become a good friend of mine, and whose work I respect, and whose opinions I greatly value. So please enjoy this conversation with Julius de Kempenaer, creator of the relative rotation graphs. So it's great to sit down today with Julius de Kempenaer, founder of RRG, or creator of the relative rotation graphs. Julius, good to see you again. Happy New Year. Happy February. How are things? How
Yeah.
are things your way?
Well, things are good. As you can see, I'm in my new space. You remember that I've been doing all that refurbishing, so it's now finished. So I'm very happy that I've got my desk back. I got my big screen, so and now I can,
I
when
love
I
it.
talk to people like you, I can have a decent conversation.
It's a professional background. It looks comfortable. It's well lit.
It
Congratulations,
is.
man. You deserve a good workspace. You've been in some interesting workspaces. I don't know if everyone knows can respect the different places you've been in on your property as you sort of get things going. But I'm glad you're
True.
at this point now. You're looking good.
Thank you.
So, markets obviously have been, confusing, frustrating, challenging for a lot of investors. 2024, obviously one of the most bullish years I think you and I have experienced in quite some time. All of a sudden, 2025 having a very different look and feel. Here in the US, we've got a lot of political changes, a lot of policy changes, Fed rate cuts, geopolitical risk across the world. Sort of start at a high level. I mean, when you're assessing conditions here in early February 2025, what stands out to you? Do you find yourself optimistic, less optimistic? Where's your head at evaluating the current conditions here?
Okay, so interesting. If I would sort of listen to my day-to-day senses of what's happening in the world, and I don't read a lot of newspapers, but you pick up the news everywhere. It would be very easy to get super bearish because of all the stuff that's going on, like politically,
Sure, sure.
geographically, wars going on, etc., etc. But then I look at the charts, and in my case, more specifically, the various RRGs. It's pretty damn difficult to get bearish. If I start at, for example, like on an asset allocation level, which is, if you want to start at a really high level and you start at from an asset allocation point of view, then SPY, so stocks, is still on the right-hand side of the RRG, which is positive. Bonds are still on the left-hand side, which is negative. But what really stands out right now is commodities. The tails for commodities are actually super, super strong. So again, from that perspective, really high level, I would say still preference for stocks, definitely preference for commodities, and the US dollar is super strong in
Yeah,
terms of currencies. So that's where we are at an asset allocation level, US based, basically.
yeah.
And when you then take the next step, and one of the RRGs that I look at very often is growth, value, and size. So it's an RRG that shows growth value relationships, but also breaks it down in large cap, mid cap, and small cap.
Okay.
And what you see there is that, first of all, large caps are still leading, but it's predominantly the growth large cap stocks, which is basically a continuation of what we've been seeing, definitely the last year, but probably the last 2 or 3 years. So value is nowhere to be seen in no size class, so not large, not small, not mid. So it's large cap growth, which is the S&P 500, and the S&P 500 is still in the bull market. If you
Mm.
could ask me, like, what do you think about the S&P 500 and the chart, I can come up with a gazillion reasons why I think it's going to be sideways to down for the next couple of weeks. But that is, within the larger term trend, it's very hard to be super bearish.
Yeah.
Okay, I'll be blunt here. I don't see a crash coming. It'll be very hard in this kind of market conditions to see the S&P 500 lose 50%. I cannot see it at the moment. And when you bring it to, if you then go another step and you go to the sector level, then again, it's very difficult to get bearish, because if you look at the sectors that are leading, it's consumer discretionary, super cyclical, super growth orientated. It's communication services, Meta, Google, all that kind of stuff, super, super big, large cap growth stocks. It's financials, and it's technology. And then the fifth one is industrials. But the best four is discretionary, communication services, financials, technology. Another way of looking at it, if you would translate that to market capitalization, or even better, beta, that's a lot of beta. That's all of that is high beta stuff.
Sure.
And tech and consumer discretionary and communication services together is probably between 45 and 50% of the market cap. When these sectors are doing well and outperforming the S&P 500, because that's what they're doing, it's very hard to be super negative on the S&P 500. I see negatives. I see some problems charting wise, but for me, it's more like trading range related, and you'll see some sector rotation going on. But longer term, we're still in good shape.
No, that's really well said, Julius. And again, what I love about your work is it's focused on relative strength and relative performance, right? I mean, and just seeing what's working and what's not relative to one another. And when you do that, I think you realize that a lot of the movements that we've seen, a lot of the short-term kind of dislocation or short-term fluctuations, still some of the larger themes that we've been observing through 2024 still kind of very much in play here. If we could, I mean, everyone loves a good origin story. I think the way that RRG kind of got to this point where we're able to make those assessments you just made and actually look at them visually is pretty awesome. I mean, what a cool time to be able to analyze these charts. But we're looking at the 11 S&P sectors rotating around the benchmark. Can you just give us the quick version? Why is this visualization so powerful? What draws you to those sectors that you mentioned that are showing strength? What on this visualization tells you that they're the right places to be at the moment?
So what part, or how did I get to the visualization?
Both.
Okay, so how did I get to the visualization? Well, that story goes back to probably early 2000s, and I was talking to a guy in Boston who worked for Fidelity. He was a technical analyst, and we always had to talk about sectors. And the problem with these large institutional guys is that they are kind of interested in what the market is doing as a whole, but then again, not really, because there's nothing they can do when the market goes down. So their game is relative strength. The only thing they want to know is this thing going to outperform my benchmark? That is pretty much the only thing that's interesting. That means if you translate that to technical analysis, that your only tool in your toolbox is relative strength, comparative relative strength analysis. So that was my tool. That was my weapon of choice to attack all these fund managers on the institutional side. But then you have a problem that you're competing with a gazillion other brokers and salespeople and analysts on the sell side who want to get the attention of the fund managers. And I've told this many times to many people. I am probably the worst salesman in the business, because if you're not interested in what I'm doing, I just can't. I don't care, which is very bad from a sales perspective, but that's just how it is. And the bank always, wanted us to get better at sales and organized courses, and you got to go to a course.
Yeah.
And one day we had a course in-house, and it was by an English, Scottish guy who worked in London in finance forever in sales. And he spoke the epic words, "You gotta make the fact sizzle," in a fat Scottish accent. If you want to grab the attention of the fund manager, you got to make the fact sizzle. And I thought, that came across like, all right, that hit home with me. You got to make the fact sizzle. But how do you do that? You got to think out of the box. So I started working on some sort of a ranking mechanism, which I had, because relative strength, raw relative strength numbers, you cannot compare. It's just a raw number. You can't really compare it. You got to go through some sort of a normalizing process. A lot of people do that by anchoring back like 12 months relative strength, 6 months relative strength, whatever.
Yeah.
Didn't work for me, because it only tells you whether that stock has been higher than 12 months ago, but whatever happened in the 12 months in between, it was an unknown. So I sort of devised what is now known as RS ratio, and that helped me to create a list. And that all happened around 2000, 2001.
Yeah.
Dot-com bubble, NASDAQ going to 5,000 and, all the way up there. And then all of a sudden, these markets started to come down. But obviously, there is an element of trend following in that algorithm. So it takes a little while before that algorithm starts to respond to those declines. And I got an email from an Italian investor saying like, "Hey, Julius, this time your system didn't work too well." And then in the well-known Ralph Acampora style, I had to say that, right, like, all right, what am I going to do here? So I started thinking like, okay, so how I need some sort of an early warning system, and started playing with momentum, rate of change. It's a leading we know it's a leading indicator. Rate of change turns before the market turns. So I already had that RS ratio metric. And then I started to apply rate of change techniques on that. And that over time evolved into what's now known as RS momentum. So I had two columns of two metrics in a table that I used for my ranking. But we're technical analysts. We like to visualize stuff. And I started playing with it. And I had those two lines, and I just plotted them on a price chart, like we plot an RSI or a MACD or a stochastic or any other indicator. But I still had to do my one. It was one chart. You flip to the other one, and you flip to the other one, and then literally on one day, this was all huge spreadsheets. This is 2000. There's no Python. There's no AI. There's no whatever. It was Excel and a lot of Visual Basic code. My Visual Basic code, which means I was the only one who could read it, who could use it, and nobody else could, because I knew that if I change this here, then everything else starts to work there, and it's a mess. But it worked for me. So I was playing around with those two columns, and I was literally playing like, hey, what kind of chart formats do we have? And then I hit on a scatter plot. And I just get that scatter plot, and you see a lot of dots. It's like, oh, what's that? And figured it out, like, oh, this is kind of interesting, and started monitoring that and then updating it with new data. And I thought, oh, this is interesting, but this is only the last observation. It's quite interesting to see where it is now, but where is it coming from? So again, 1 week of Visual Basic programming, figuring out how I could add the previous data point to that scatter plot, and then I had two dots. And then I was smart enough to make one dot very vivid and the other one a little dimmed in color, so I could see sort of the direction.
Yeah.
And then I could connect them together. It's like, oh, this is pretty cool. So this evolved over time to what is now known as an RRG. And when I had that, I could send to that dude in Boston an image, which like, here you go. This is what's happening in your universe, and you got like that whole universe in one picture. I printed that in the back of my reports. So and I remember the conversation you and I had at one stage, where you told me I am always printing off that last page of your report, which was that, well, what's now known as an RRG. It didn't look remotely as it looked right now, but it was the basis. And you said I printed off, and I was like, why would you do that? Why would you print it off? And then you told me like, I'm collecting them and I'm stacking them on top of each other, and then when I do like zip it, it starts to move. You can sort of see where they are, and that was like, for me, there was a light bulb moment, because then I was like, all right, so if we can make that animated and make that work interactive, that's a really cool thing. And that that happened over time, and then companies like Bloomberg and Reuters and Stock Charts and a few others came, and then this is the modern version of that notebook. I always explain it to people that when you were in high school and you were bored, you started to draw a little man on the bottom of your notebook with a hat, and then at the end you saw him like walking like that if you would rip the pages. So it's a funny story, but in the end of the day, that's what's the basis of that RRG.
So it's so interesting. I mean, now, so fast forward to 2025, we have this fantastic tool now, a modern version of what you described. You mentioned earlier how stocks still commodities strong, large cap growth still doing well. here we're looking at the 11 S&P sectors, and clearly it seems to me the growth sectors are in a stronger position. And that gets to what you were talking about, where you really, even though we've seen some disruption, some of those previous leaders still kind of showing strength on a relative basis, right?
Yes, absolutely.
Yeah. So tell me this, right? So if these are the conditions here in early February 2025, we're also seeing some of the sectors like XLY that have been the strongest starting to rotate kind of southwest on the weekly
Yep.
RRG. Things like healthcare heading northeast. Is this the beginning potentially of a rotation, or how do you gauge, current strength versus more of a forward-looking, these are your emerging new leaders? Like, what would you need to see on here to say, okay, now's the time when there's a rotation happening that we need to be aware of?
Yeah, so the rotations you were pointing out are definitely there. I think the fact that XLY and XLF and XLC are sort of pointing lower over the
Yeah.
last couple of weeks, that's the reason why the S&P is not really pushing higher, because
Mm.
these are important sectors. They're now over the last couple of weeks doing not too well, but they are very high on the odds ratio scale.
Yeah.
And we know from years of experience that, for example, a sector like XLY, which is now the highest rating on the odds ratio scale, that is a very good candidate for a rotation that completes on the right-hand side. And what I mean by that is that you will, in a very strong relative trend, what you will see is that a sector moves from leading into weakening and then curls back up and moves into leading without hitting the lagging quadrant. And what that translates to on a price chart with relative strength is a relative strength line that puts in a higher low. We always talk about higher highs and higher lows in price charts. It goes for relative strength lines the same. Relative strength line doesn't go up in a straight line. It just follows trends like price. And when you see higher highs and higher lows in relative strength lines, that's a strong sign that on an RRG that translates into leading, weakening, back to leading. And then what you did is you put in a new higher low. So the further a sector is to the right, the higher the odds that it's making that very strong rotation, leading, weakening, leading. Same goes on the other side, on the left-hand side, where you, for example, see healthcare now picking up a little bit, but that's the second to lowest reading on the odds ratio scale, which is very low. So it's the bottom of the list. This one is a very good candidate to pick up in improving, rotate, roll over without hitting leading, and then going improving, lagging, back to improving. That is the characteristic of a relative line that moves lower highs, lower lows. That's what you see there. So when is it going to change? That's a bit arbitrary and a bit subjective, I would say, most of the time. When you get closer to the 100 line, the 100 level on the odds ratio scale, because that's where your trend changes. If you move over, that's when the trend change has happened. Obviously, we want to beat that a little bit. So, for example, XLK is a good example of something that is now about to move into the leading quadrant. That is where that trend change is taking place. And I always tell people, because I always get asked, what are the trading rules? Well, there are no fixed trading rules for an RRG. It's a chart, it's a visualization tool, it's a chart format. I always counter that, like, what are the trading rules for a bar chart? It's different for you, it's different for me.
Sure.
Somebody likes to trade a 5-day breakout, somebody else likes to trade a 20-day breakout, somebody likes to trade on a 5-day moving average, somebody else likes to trade on a 50-day moving average. It's all the same data sets, it's a different interpretation. RRG is no different. But what we found out is that the move from improving to leading, so the trend change, is obviously the most interesting part to catch, because you're buying the low or getting in at the low, but it's more dangerous. It's the riskier trade. The ones that are completing on the right-hand side or the left-hand side are the more reliable trades, because if we focus on XLY, which you now see moving from leading into weakening, when it turns back up and moves back into leading, what that means is that it is starting the second or the third or whatever new up lag in an already established uptrend. So it's much safer and much less risky trade or position to move into. So that's a few things that we kind of picked up over the years in looking at it. Because
Yeah.
when I first looked at an RRG, I thought, oh, this is great. When it moves from improving to leading, you buy, and when it moves from weakening to lagging, you sell. It's not that easy.
It's not that
That's
easy. And you and I,
yeah.
Julius, have found very similar things. And I found one of the most, at least one of the most consistently profitable approaches I've seen with the RG are these little cyclical movements that happen far to the right side of the y-axis, right? And that's what I think what you're getting at is, we can't assume that the XLY is going to round trip all the way around the four quadrants. It could just make this little cyclical motion here, which means it's outperforming pretty consistently. It's sort of just the pace is increasing and decreasing. It's really, really helpful. Now, I want to respect your time, and I know that you started writing a series of blog posts on stock charts, which you called the best 5 sectors. And I'd love to just talk briefly about that, because that, again, I've used this for many years. I know others have gotten really comfortable with the visualization. Talk about this sort of next layer of how you're starting to use this to evaluate some of the better opportunities within the universe here.
Yeah, so there's an interesting story behind that as well. A lot of people ask me for trading rules, and I always kind of sort of bunk that, like say, there's no trading rules because it's, blah, blah, blah. In the end of the day, it's a set of data with some metrics, and you can try to put some rules to it.
Yep.
I'm not the biggest fan of it. I always think of markets as a puzzle, and we are analysts, and we need to basically piece together the pieces of the puzzle to get what we want. Problem is that overnight, some idiot always throws around all the pieces of the puzzle, so we're going to start the puzzle every day at new. But I got a call from a U.S. investment manager who I met 13 years ago in 2011 when RRG was just published on Bloomberg. I had a chat with him. I met him in New York. We didn't stay in touch. We know of each other. We weren't like talking every month. But he rings me up all of a sudden and says, "Hey, I have a number of ETFs listed. I am looking to list a U.S. sector rotation ETF, and I'd love to do it based on RRG." So for me, that was sort of like a little push in the back, like, hey, because I had done a ton of work. I've been playing around with strategies and back testing, and how it goes. You dive into it, you spend a couple of nights sleepless, and then it sort of dies because you got other stuff to do.
Sure.
Went through a few iterations of that, and then this call comes in, and I was like, all right, this is a serious request. So let me push this to a higher level, which was when I started to do a little more work. And I came up with a strategy, an RRG-based strategy, which basically combines the daily and the weekly observations in a specific way. And that allows me to create a ranking, basically 1 to 11 for the sectors. And then I started to do some portfolio construction work, because as you know, a trading rule is one thing, but building a portfolio is different. And I've actually written an article on stock charts years ago. You got to look it up. Something like, the title of the article is something like technical analysis and portfolio construction are 2 completely different animals in the same zoo, which basically means that they are they need each other, but they are 2 different disciplines. So you can come up with a rule and a trading idea, but putting it into a portfolio is different. How much are you going to buy? What's the weighting in the portfolio? What do you have a target? Do you have stop loss? All that kind of stuff. So I put together those 2 things. I came up with that algorithm for that list, and basically started an equal weight portfolio, 20% of each of the best 5 sectors. I've done a lot of testing on that, and that gives this particular strategy that I'm now writing about, because I knew I needed a push in the back. I needed a stick behind the door for myself to be consistent, because it's very easy to come up with a strategy and then not do anything with it. It's just so, by forcing myself to write about it every week and to monitor it, it's documented, it's live, everybody can see it on stock charts. And I've actually, I opened up, or I created a Yahoo Finance account, because they have a portfolio management tool where you can very easily stick in your trades. So I started that portfolio in the first week of January, 2nd of January. Basically, like, I bought so many shares of this, so many shares of that, calculated, 20% of $100,000 divided by the price of the shares equals so many shares, put that in there and started monitoring it. I've done two switches since then. So the technology sector dropped out of the top 5 after a couple of weeks.
Yeah.
And then it moved back into the top 5, not this week, but the week before. You can read it back. It's in the number blogs.
Yeah.
So that's one of the things that was necessary for the strategy. It shouldn't trade in and out on a very regular basis. This is a long only strategy that should be easy to follow for anyone who wants to use it. But also, if it's in an ETF, you don't want an ETF trading in and out every day.
Sure.
So I am now doing it on a weekly basis. The ETF might do it on a monthly basis. I don't know. We haven't decided that yet, but that's work in progress. But for me, this series forces me to, put it out there, write about it, and track it. And I print the portfolio overview in every article. So far we are up like 50 basis points right now. It's not a lot, but 50 basis points in 6 weeks is not bad either. I'll give you the 5 best charts. I'll give you a summary, and then usually in my weekly video, I sort of hint to it, and then I look at the other sectors or maybe what else is going on. So that's a little bit of the story behind those 5. Yeah, and there's one more thing that I everybody who knows me knows that and has heard me. I'm pretty strong on like doing things right in terms of portfolio management.
Sure.
And with this portfolio, there is a flawed element in this approach. I'm aware of it and I'm dealing with it. But the fact is that an equal weight portfolio using cap weighted instruments is not the right way. And the reason is that XLK technology is about 30% of the market cap. In my equal weight portfolio, I have a maximum allocation of 20% to the technology sector, which means that even when technology is in the top 5, I am underweight technology by 10%, which is in the real world a pretty massive underweight bet.
Yeah.
And I'm in a long position. So yes, I'm aware of it. I'm working on it. It needs work. It's the whole portfolio construction part of the whole deal, which is much more important and much more complicated than most people think.
For sure. For sure.
So it's going on, but
Yeah.
I know.
As a proof of concept, though, I think it's a brilliant way to sort of take this visualization that so many have used and just sort of put some specifics behind it to start to track some of the performance on there. I'm so glad that you started to do this series of articles, Julius, and I hope everyone will definitely include a link so that people can get to it. I hope they're able to follow along as well. And it seems like this could be early days. I mean, I hope this is the beginning of some really good things. And at some point, we have an RRG ETF to consider. What a blessing, huh?
Let's hope so. Yeah,
Let's hope so.
absolutely. It'd be nice. It'd be nice. Yeah, absolutely.
No, this is fun. This is great, Julius. I can't thank you enough as always. I mean, we talk about the RRG certainly on our market recap show. We highlight looking at the rotations, but getting you to actually describe how things are you're seeing them from your perspective. Some of the ways you're continuing to innovate after all this time is just really fun. So thanks for coming on the show, Julius. I appreciate it. We'll do it again later this year. Okay.
Absolutely, my friend. Anytime. Don't worry.
It was a lot of fun to relive some of my early experiences working with Julius, learning about his RRG and The story he told, sort of in the origin story, is 100% true. I remember him sending us the report, and we would take that page, that one page, and we'd create like an old school flip book and literally look at how they were moving. I remember showing it to him. And then years later, on platforms like Stock Charts and Optima and others, you can hit the play button and move the RRGs and put them into motion. I think it's a brilliant way of really visually representing sector rotation and leadership rotation, which is a phenomenon that so many of us take for granted. But I think as a visualization, it's a great way to focus on the opportunities. Particularly, I thought his observations about growth sectors, about some of the leadership areas in 2024 that have struggled a bit here in early 2025. I thought his comments about how, looking at short-term rotations versus long-term changes of character, I thought were really, really interesting. We have links in the description, by the way, for some of the articles that we talked about in the episode. We talked about an article years ago where Julius talked about technical analysis and position sizing. We also have a link to his recent series called the Best 5 Sectors that he's been producing on Stock Charts, really looking at multiple timeframes and combining them to identify sector opportunities. Really fun conversation. Again, thanks again to Julius de Kempenaer of RRG Research for joining us here on the podcast. Very curious if there are others that you would like us to interview. We've had some really good interviews. We're just over 25 episodes of the new Market Misbehavior podcast, which we launched last fall. We've got some really good interviews lined up in the weeks and the months to come, and we're always looking for more potential guests. So please, wherever you're listening to this, drop a comment and let us know who you would like to see interviewed on the Market Misbehavior podcast. By the way, if you want to learn more about some of the techniques that we talked about, some of the technical analysis tools that fuel visualizations like the RRG and can help you take your analysis and your money management skills using technical analysis to the next level, our Market Misbehavior Premium memberships may be a great way to renew your commitment to better decision making in 2025 and beyond. Go to marketmisbehavior.com/premium for more information. 3 main benefits to the premium membership. Number 1, you have access to all of our virtual courses. We have a couple courses to start. Flight School Behavioral Investing, where we talk all about behavioral biases, technical analysis, and how they relate. We have a special course for financial advisors about how to use technical analysis and charts to enhance and enrich your relationships with clients. We've got some other really cool courses planned out for 2025. You'll have access to them all on demand at your own pace. You also have access to our members-only reports like our weekly flight plan and our monthly chart review. And you'll have access to a members-only community. I'm in there every day answering questions, seeing what people are talking about. You might see some of my premium members weighing in if you ask questions of the community. But it's a supportive group, it's a growing group, and a vibrant community navigating these markets. So hope you'll consider joining us. Go to marketmisbehavior.com/premium for more information. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. That's it for this episode. Thanks so much, as always, for joining me on the Market Misbehavior podcast. Wish you well here in the early days of 2025. And remember, it's always a good time to own good charts.